Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 18th of September, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are some of my market observations. The ASX 200 closed last night at 8,140. This is a new high. This is positive. So the big question now is, will the Fed cut rates by more than 25 basis points? I happen to be in the 25 basis point camp. Reversing monetary policy from tightening to flat and now to easing is a big signal. Do they truly need a 50 basis point cut right now? After all, inflation is down, but if you cut too much, would that maybe cause inflation to not continue going down? Another market concern I have is in regard to tariffs. In the United States, there's a lot of discussion about tariffs on the political landscape. One big example of when tariffs were raised across the board was in 1930. It was to stimulate domestic production. Instead, it led to retaliatory tariffs by other countries that caused further economic slowdown across the globe. We had a recession then, and we ended up having the Great Depression. Tariffs are charged to importers. The exporter does not pay anything. It is domestic tax and causes consumer prices to rise. How is this helpful? Australia eliminated most tariffs in the 1980s, and as a consequence, they had no recession since 1991 until the present. Eliminating tariffs has worked, but raising tariffs across the board, well, we saw what happened last time. It took World War II to get out of the Great Depression. Do we really want to take that chance this time? Here's a chart on federal minimum wage. As you can see, it kind of has been stagnating for quite some time, unlike here in Australia where minimum wages have been rising. Here's a fascinating chart on the CAPE ratio, and it shows that the S&P 500 is right now overvalued. So you ask, what is the CAPE ratio? It's simply the price of the stock divided by the average earnings per share adjusted for inflation. With where it is right now, you can see the S&P 500 is near a peak. Last time it got near a peak, it sold off dramatically. This is not a real good time to be going into the market and making major purchases. You got to be very selective. As I've said before, it's a stock picker's market right now. Just don't go blindly buying equities. This is an interesting chart. It has nothing to do with the markets, and I just have to laugh about this. It shows a chart where an 8-year-old girl stole a car and drove. It was a 25-minute joyride. So this happens in Australia, but an 8-year-old, a girl, going that far? I mean, this is amazing. Here is an oil sector political misinformation situation. That right now in the United States, the Republican Party is talking about how great they are for the oil and gas sector. The Democrats are a little bit on the defensive because they're looking at having a more even balance between fossil fuels and renewables. This chart shows on the left how the oil and gas sector has performed under Republicans, and on the right it shows how the oil and gas sector has performed under Democrats. If I was an oil and gas executive, I would definitely be voting Democratic. This is an absolute important chart that you should keep for your records. This shows what happens after the Federal Reserve starts cutting rates. This starts from 1999 to the present. What we see is that with the initial rate cut, the markets go up a teeny bit. But when you go further out, 1 month, 6 months later, the share markets are down. Whereas the opposite happens when rates start to increase, the markets initially go down, and then further out, they go up. Think about it. Do we really want the Federal Reserve to start cutting dramatically at this stage? It could really spook the equity markets around the world. Here are 3 companies I wanted to show today. The first one is Aristocrat Leisure. The code on the ASX is ALL, and it's trading at $56.63. You look at the chart, this is a 5-year chart. It shows that it's in a very strong uptrend. I've covered Aristocrat before. I like it, so I wanted to go back to it. These are estimates by Citibank. Now, amazingly, the market cap for Aristocrat is $35 billion. Price target by Citi is $61. The revenue growth from 2023 to 2026 is 5.4% per annum. The earnings per share growth in this period is 12% per annum, and the dividend growth is 14% per annum. These are all solid numbers. I also like looking at shareholder equity growth. Well, this is 10% per annum. These are all dramatically above what you can earn in bonds. On a PE basis, the 2026 earnings per share estimate is $2.83, equating to a 20 times PE. On industrial companies, that's a little bit on the cheap side. The yield on the 2026 dividend estimate of 94 cents is only 1.7%. They plow their money back into R&D. They have free cash flow of 4.5%, which is good, and a payout ratio of only 33%. This builds up retained earnings, but it also allows for them to increase the dividend if they need to keep the share price up, which is sort of like a free put option for equity investors. This is a global developer and manufacturer of gambling and social media type games. They've done extremely well. I rated a buy. Second company is Premier Investments, code PMV, and it's trading at $34.77. This company has had a roller coaster ride, but the past year and a half, you can see it's been going up sharply. Taking a look at Premier Investments fundamentals, these estimates are from JP Morgan. It has a market cap of $5.5 billion. They have a 12-month price target of $34. The revenue growth in each of the next 3 years, 2024 to 2026, is only 2.2% per annum. The earnings growth rate is only 1.8% per annum, and the dividend growth rate is 4.5% per annum. Now, on the dividend growth rate side, that's because the 2024 dividend is lower than it traditionally is. The shareholder equity growth rate is 4%. PE on 2026 earnings estimate of $1.75 is 19.9 times. The yield on the 2026 dividend of $1.31 is 3.8%. Has decent free cash flow at 6.2 and a payout ratio of 74. Premier Investments operates a specialty chain of retail fashion stores, and they also have investments across the board in share market. Saul Lewis, a chairman, major owner. Looking at these numbers, it has slow growth, PE of 20. I don't really see any reason to buy this company. You can buy government bonds and get a better return. So I rate it neutral. Newmont Mining. Well, Newmont bought Newcrest, and so there's a lot of Australian shareholders, and Newmont, a US company, is also trading on the ASX. Newmont is trading right now at $78.78 under the code of NEM. Take a look at the chart. This is not a 5-year chart, that's more like a 1-year chart because Newmont trading here doesn't have a long track record. But what we see is that this chart is similar to the price of gold, obviously, because Newmont's a gold miner. On the fundamental side, I looked at Barrenjoey for their estimates. First off, it has a market cap of close to $90 billion. 12-month price target by Barrenjoey is $80. The revenue growth rate from 2024 to 2026 is 4.6% per annum. The earnings growth in this period is 5.5% and the dividend growth is 7.6%. These are okay numbers. The shareholder equity growth is 6%. That's okay also. It would be nice to be stronger. The PE on the 26 earnings estimate of $5.22 is 15 times. Now, they report all their earnings in US dollars, so I converted that into Aussie dollars using a currency rate of 67 cents. The yield on the 2026 dividend estimate of $2.34 is 3%. It has strong free cash flow at 8% and a payout ratio of only 33%. It's a global gold copper mining company. The long-term prices used in these estimates is for gold, US dollars 2,100 per ounce, and for copper, $5 per pound. We all like gold right now because it's going strong, I don't know how to value gold. I don't know anybody that knows how to value gold. I've talked to the CEO of Newcrest, and they don't know how to value gold when they were independent at the time. It's all about gold, the price, sentiment, supply and demand. So I'm not going to make a pick, buy, sell, or be neutral. I'm just saying that as an alternative to gold, this is a company to look at. But historically, buying the actual physical metal is a better investment. And with ETFs and other mechanisms, buying gold, selling gold is easy now. As always, if you want to learn more about anything I covered, or you have any suggestions of things that you would like for me to cover, send an email request to stockwatch@fnn.com.au and direct your email questions to me, Chris Pedersen. I hope you have a profitable week. Thank you for your time.